This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 93.1 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans, or you can talk to him right now at 407-916-5400.
Well, good morning, ladies and gentlemen, and welcome to the program Dollars and Cents. My name is Joel Garris of Nelson Financial Planning, and you're tuned in to News Radio 93.1 WFLA. Much to talk about on the program today, as we do each and every week. We need to spend a little bit more time on a subject that we kind of wound up rushing at the end of last week's program. That was the conversation about some of the proposals that are bipartisan, not this wealth tax Democrat proposals that are not really mired in the reality of the facts. We're not going to spend time on that today. The reality is that there are some bipartisan retirement proposals that are floating around in Washington, and obviously if it's bipartisan, that means that both parties are sort of supporting it, so that would seem to suggest that there's a greater likelihood of it passing. We were kind of ran out of time at the end, and we just want to spend a few minutes on that, talking a little bit about some of those proposals, particularly regarding required minimum distributions. And then, speaking of Washington, tax season has started here at the Office of Nelson Financial Planning. We do tax returns, and we're looking at the first few that are coming across as we're getting them done, and they are different, and it's kind of funny how they are different. One of the stated goals of the tax reform that was passed at the end of 2017 was to get your tax return on a postcard. And I suppose that is true. And when you look at the printout of the new 1040 for 2018, you'll see that it only goes half the page. So in theory, that would be a postcard, not your typical postcard, but maybe one of your larger postcards. But then there's a bunch of schedules that you have to attach to it. So I'm like, well, what did that accomplish except create more schedules? So there's a Schedule 1, a Schedule 2, a Schedule 3, a Schedule 4, and a Schedule 5. But your tax return is on a postcard, sort of, as long as you don't have to attach anything else. So as long as you didn't have anything else, any other income, if you will, besides your wage income or maybe some interest and dividends, things like that. Those are the only things that appear on the new form: wages, interest, dividends, IRAs, pensions, annuities, and Social Security benefits. And the point of that is that there certainly is a large population that just really has that. Okay, just really has that: wages, tax-exempt interest, dividends, IRAs, pensions, and annuities, and Social Security benefits. Those are still on the main form of the 1040. Okay, so if that's all you have, congratulations, your life just got simpler. If that's not all you have, then you're going to have to start attaching schedules, and we'll tell you about those here in the program. And then, of course, this past week, well, actually, we had two big occurrences at the office this past week. First of all, we had our first client meeting of the year 2018. 2019. And if you're familiar with our operation, you know that we offer a variety of events during the course of the year, but there's always sort of one a quarter that features a speaker from the industry, some comments from me, and then a Q&A session. So, and one of the Q&As was actually, one of the questions was actually something we're going to share on the program with you today, and that always, to me, when we start to do those events, so we do them quarterly, typically at the Country Club of Orlando, because that's just an easy space, good parking, and a good venue there, and so much better than a hotel ballroom. I mean, you know, hotel ballroom, you're all kind of like enclosed in. Anyway, I digress on the venue. The event always, every quarter, so to me, that's sort of the official start to the year. So I feel like it's the official start for the year, even though it's into February. It's sort of the official start to the year now that we've had that first client meeting of the new year in 2019. So obviously, we want to share with you some of the presentation conversations that we had during the course of that meeting. Some interesting stuff was shared, and so we want to kind of share that with our listening audience as well. So that'll be a lot of territory to cover in the program, but there's always time for you to add your topic du jour if you would like, and to do that, all you need to do is simply pick up the phone. Give us a call, 407-916-5400, toll-free 1-866-916-5400. So on to those bipartisan proposals in Washington these days that really appear to be probably on track for something actually happening with them, right? Because they are bipartisan. Not this Democrat stuff that has been floating around, the bashing of billionaires. You look at the two biggest billionaires in America today, Warren Buffett, Jeff Bezos. They created something. They used their intellect. And that's, after all, what made this great country a capitalist society that has generated this economy that continues to power the entire globe. And when you look at some of these proposals, how they would play out, particularly in some of the history books, these 70% top income rates, and these wealth tax transfers. As a matter of fact, there's some speculation that Elizabeth Warren's annual wealth tax might very well be unconstitutional and be pretty tough to enforce. Even France eliminated its broad wealth tax last year. So it's funny that all these proposals are being put out there at that time when the history books say they don't really work. And if even over in France they said, well, wait a minute, a broad wealth tax, that doesn't make any sense, we're going to get rid of it. I guess, but that still doesn't stop the folks that are running on the Democratic side, it seems, to be proposing them anyway. Not trying to be anti-Democrat. We try to be as apolitical as possible on the program, but it's hard to ignore all of these proposals that seem to be coming from the Democratic side of the aisle. And at the end of the day, they're not really grounded with a lot of good history, particularly this proposal on the buyback stuff. I don't know if you've heard of it, where Bernie Sanders and Chuck Schumer are coming out with a proposal that says, that we're going to restrict a corporation's ability to do share buybacks. The reality is that I don't want government getting in the middle of a company's ability to make decisions, and I hope you don't either. because that's the very definition of socialism. When you start to affect the decisions that a company can make as it relates to its earnings, and I'm not talking about regulations for the benefit of, to protect the environment or for worker safety or something like that. No. That there is a valid function of government. But at the end of the day, when you are a business and you have money that you've made legitimately, then you should be able, as a business, to decide, what are we going to do with this money? Are we going to keep it? Are we going to reinvest it in the company? Or are we going to go out and distribute it to the shareholders? Because after all, one of the mantras of a company is to protect the interests of its shareholders. And yet, that proposal would significantly restrict that ability. And so be careful anytime government starts getting into the decision making. That's a decision that a company makes. It's not a regulation. It's not a safety regulation. The reality is, when a company makes a decision, it's made its money, it's made some earnings, it's paid taxes on it, and ultimately now, hey, what are we going to do with this money? That should be exclusively the purview of the company. This notion that share buybacks undermine the well-being of the American worker is simply false. You can look at the increase of $208 billion through the first 3 quarters of 2018 that U.S. companies did just last year. $191 billion of additional share buybacks, while at the same time, 90% of Americans received a net tax cut courtesy of these tax cuts, and wages increased over that time period by 3.2%. So it's hard to argue in an era where you saw a much greater level of share buybacks that somehow share buybacks is the demon poison, if you will, that is keeping the American worker down. And the statistics would say exactly the opposite of that, particularly over the past 12 months. A lot of share buybacks, but yet at the same time, some of the highest wage growth over the course of the past year that we've seen in a decade. So I'm not sure where all this bashing of billionaires goes. Be careful as you run down that path, because folks like Warren Buffett, Jeff Bezos, those are folks that came from zero all the way up. I mean, that's part of the American system. That's part of what makes this country great. That's part of what makes this country unique. But anyway, shoot, I said at the beginning of the program I wasn't going to digress on that. Just couldn't help myself. Okay, all right. Anyway, when we get back, we're going to talk about the bipartisan. That would mean agreement from both parties as to what the latest suggestions are on required minimum distributions. Talked a little bit about this on the program last week, but ran out. So when we get back, we're going to get focused in on what we're going to talk about here on the program for the rest of the hour here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
That is correct indeed. Thanks, Bud, as always, for that intro. If you'd like to add your topic to the conversation today, just pick up the phone and give us a call, 407-916-5400, toll free 1-866-916-5400, or you can drop us an email. That email is Joel, Joel, at nelsonfinancialplanning.com. So we were talking a lot about this on the program last week, and then sort of ran out of time as it related to some of the changes that are being proposed on a bipartisanship basis in Washington. Specifically, we got through the part about how the proposal it has some language in it that encourages people to annuitize their 401k account. And then if they took a portion and annuitized it, then you would reduce the required minimum distribution because that would just be imposed upon the rest of the account balance. And then you would be able to purchase the annuity that would start making payments down the line. So here's how that works. So let's say you had $400,000 in your IRA. You could take now up to $200,000, put it into a deferred annuity, meaning not an immediate one where it starts to pay money out instantaneously. That would sort of defeat the whole purpose of what you're trying to do there, and not really change your required minimum distribution either. But if you do it in a deferred annuity, then you could take $200,000, put it in a deferred annuity, and then you only have to take the required minimum distribution off of the remaining amount. Well, that's all fine and dandy, I guess. The reality is that if you're retired, that most people are able to meet their required minimum distribution just simply by normal cash flow needs in retirement. So, and I also don't like the notion, as we talked a little bit on the program, of the government really kind of pushing more this annuity option. Annuities serve a function only to address the emotional aspect of your money. And I'm not sure that I want the government telling me or saying, hey, I'm going to give you an incentive if you play into your emotions about fear and decide to put money or park money inside of an annuity. The reality is that the interest rate, the interest rate that annuities pay is not particularly high. So you're basically shifting money over into something that, okay, it's going to meet your emotional need of, I don't want any fluctuation, and that's going to, reduce my emotional concern, but it's going to heighten your future concern because the reality is it barely stays up with inflation. So that means that when you start to take it out, you won't have kept up with inflation, which means that after taxes in particular, you will be, in fact, losing money. How's that going to work for your emotional stability? Not too well, in my opinion. But this is one of those things where, government gets involved to try and address something, and it loses sight of the proper way of doing things. Trying to manage human behavior and human emotions is not sure that's a role for government. Seems to be a general theme on this program in the comments today. We'll shift some gears in a little bit. Don't worry. The rules also would change required. The rules being proposed would also change to the required minimum distributions overall. And this is where it gets kind of interesting. Less than $100,000 in an IRA allows you to basically skip the distribution. Approximately half of all IRAs for folks that are over age 70 and a half today would fall in that category. Perhaps the benefit of that would probably eliminate the potential of, if you forgot to take your required minimum distribution, you wouldn't be facing a tax bill or the tax penalty of 50%, one of the most onerous in the tax code. The reality is, and I always get cautious when I say this, but so we've now been doing tax returns for 17 years at the office, okay? And I've just never seen enforcement on that RMD rule. I'm sorry. It's not something that they chase. But the reality is that this would allow the individual who forgot to take it, assuming that his balance was less than $100,000, that they would not have to take it. The reality is, most of the time, if you've only got $100,000 or less in your IRA, chances are you're retired, you got less than $100,000 in your IRA, I'm pretty sure you're kind of living off of that, which that satisfies the required minimum distribution. The other thing that the bill would do would be to raise the required minimum distribution age to start at 72 in the year 2023 and then 75 in the year 2030. So that's cool because then you could delay it for a longer period of time. My comments are, it's fascinating that they would. Remember, the purpose of the required minimum distribution rules are what? The purpose is to take money that's never been taxed and force it to be taxed. Okay, it's a money race by the federal government, and that's fine, and it's understandable that they don't want that money going generation after generation without ever getting taxed. So that's the point of the required minimum distribution rules. And the reality is, it generates money to the government. If you don't have to take it out, and you didn't, then you wouldn't be reporting it, because you have to take it out. You report that as income, and then guess what? You pay taxes on it. So that generates money to the government. So I think it's fascinating, don't you, that they are suggesting of ways of, you don't have to take it if your balance is under 100, or in the future, the required minimum distribution wouldn't kick in until age 72 or maybe age 75. Fascinating stuff, right? Considering that the folks in Washington don't have the guts to deal with the real problem that's facing our country. The real problem that's facing our country, the massive debt that's created courtesy of Social Security and Medicare. So they're happy to talk about how we can boost the required minimum distribution age and, in fact, then reduce income to the government, because acknowledging that people are living longer. But heaven forbid that they start to figure out Social Security and let alone Medicare, which has a shortfall of about 7 times more than what Social Security has over the next 20-odd years. They're focusing on that rather than Social Security and Medicare. Social Security starts at 62. Medicare starts at 65, and we're going to right now. Oh, well, people are living longer, so we're going to shift the required minimum distribution rules. Okay, that's fine, great. Maybe you should think about doing that for the other stuff that's creating a far more substantial problem for our future generations before you get too fixated on stuff like this. But anyway, just a comment on, prioritizing and, dealing with the biggest problems first, because the sooner you deal with the biggest problems, or the earlier you deal with the biggest problems, then the less draconian the solution has to be, right? I mean, interesting. Anyway, one of the things that we mentioned at the beginning of the show was that we had a couple of big things that happened this past week. The first one was our first client meeting of the new year, and so that's always very, very exciting, because that kind of kicks off the year. That kicks sort of off tax season, and sort of gets the year. I sometimes feel like the year doesn't get started until we have that first client event, and then we're on a roll, having won a quarter for the rest of the year. Anyway, it also we also welcomed a new member to our team. And we welcomed Kristen Cayley to the team this past week. And what's exciting about her, not only is she a former intern. So of our team of, this is kind of fascinating. So on our team of 8 people, okay, 3 of the 8 came from our internship program that we've had through UCF. So that's pretty cool, isn't it? Hey, if you're an employer out there, don't forget about giving a shot to interns. We're not a very big company, but we always found and we're able to take advantage of college interns, and we have one even now. And for us, I mean, almost half of our group has come through our internship program. So pretty valuable. If you're an employer and you're not taking advantage of that, you really need to be thinking about that, because there's a lot of good folks out there that like the extra money we pay our interns, and like the notion of getting some experience and being able to progress from there. But anyway, digression. What is that? Like the 10th digression on the program. Anyway, Kristen was an intern many years ago, went off, got her master's in tax and master's in accounting, and and then went to work for a global accounting firm for a few years, and then has rejoined us. So we're excited to have her back. She is now a CPA, has that designation, and we're particularly excited about that because then that's a nice compliment to Christina, who joined us on the radio program about a month ago. She's been with us for 13 years. She is an IRS enrolled agent. So we've got a nice complement of folks in the office on a full-time basis that can help work through these tax issues, because it's fascinating just how much this tax stuff really interplays with the investment side, isn't it? I mean, it really, so I always kind of laugh, when you hear other firms and look at statements from other firms, and in the fine print on the back, it always says, "We do not provide tax advice. Please consult your tax advisor." I always laugh at that. I always find that kind of comical, because if you're making an investment recommendation or you're putting together a financial plan, how in the world can you not be talking about the tax implications? And most importantly, how in the world, if you are talking about the tax implication, how are you not standing behind what you say? I don't understand that. So in contrast to all that fine print that you hear on statements, we embrace that at Nelson Financial Planning, and we just added CPA to our team, and specifically because we think that there is more and more conversation that has to happen if you're putting together somebody's finances, or putting together a plan, or putting together a retirement income plan, where you've got to be able to provide tax advice and stand behind that tax advice. So that was the other exciting thing that happened this past week at the office. So when we get back talking about taxes and the simplification, well, yes, sort of. Certainly for a group of people, the tax return did get simplified. But for anybody else that's got any kind of one-off things, and there's enough one-off things to pretty much put the majority of people in that category, then stay tuned after the break, and we'll break it down on what your new tax return looks like for the year 2018. This is Joel Garris of Nelson Financial Planning here on News Radio 93.1 WFLA.
This is Bud Hedinger. You can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1. This is Joel Garris of Nelson Financial Planning. So we'll talk about this new... the new tax form, the new tax return, and that'll segue nicely into an email that we got from Frank during the break asking about something he saw on the news about how some people are paying more on their 2018 tax returns despite these tax cuts that were supposed to have everybody paying less. And the question is, what are you seeing so far in these kind of initial tax returns? So love that question, Frank, and we've got some thoughts on that. We haven't seen a whole lot of them. Got a few that I'll review this afternoon, but not a whole lot, but there is some interesting patterns. So to that, though, here's your new 2018 tax return. You ready? So the front page, which isn't really a page, it's sort of like a postcard, except it's not like your traditional postcard, hello from the Grand Canyon. It's, kind of like more that, like that 5x7 type of postcard. So it's the big postcard, if you will. So the front page of that postcard is very simply your name, your address, your social, your dependents, and the signature block. That's it. That's all it's on the front. Okay, so that's good. That should be pretty easy to do. The second page is where you would list your wages, your interest, your dividends, your IRAs, pensions, and annuities, and your Social Security. Those are your main 5 lines. If you've got just stuff that falls into that category, congratulations, this is going to be a super simple process. If not, then you may find yourself doing one of 5 schedules to attach and supplement. And so basically, when you look at this format, it's like they took chunks that was on the 17 return under the old, kind of the larger version, if you will, and they pulled it off. So the first chunk that they pulled off was the sort of the rest of the front page. And the rest of the front page would be any other types of income like refunds from state and local taxes, alimony, business income, capital gain, rents, farm income, unemployment compensation. So, I mean, that's a lot of categories of income, right? At the end of the day, those categories all now go on a separate Schedule 1, and as does the adjustments to income that you would typically have seen on the front page, which would be things like educator expenses, your HSA deduction, your moving expenses, very few can get those now, your SEP contributions, your self-employed health insurance, your alimony paid, your IRA deduction, your student loan interest. That stuff that was sort of at the bottom of the front page also gets moved over to the Schedule 1. So Schedule 1 basically is like the rest of what used to be your traditional front page on your tax return. And then Schedule 2 is for tax. So then Schedule 2, 3, 4, and 5 are sort of pulling out some of the categories that you would have traditionally seen on the second page of the 1040 under its old form. So Schedule 2 deals with tax, things like alternative minimum tax. That's where you would true up any tax credit or overpayment or underpayment that you would have gotten with respect to your health insurance. Schedule 3 is things like the retirement savings contribution credit, your foreign tax credit, and your credit for dependent care expenses. So again, that sort of chunk got moved off of the back page in the traditional sequence and shifted over to a separate schedule. And I understand the concept is that most people at the end of the day just have the wages, the interest, the dividends, the IRA, and the Social Security, and that's fine. And that's the simplification part of it. But there's a whole lot of other folks that will find that they have at least 1 or 2 items that will require them to pull in one of these additional schedules. The last 2 new schedules, Schedule 4 is other taxes. So that would be like if you took money out of your IRA early, you have to pay a tax penalty on that. If you've got self-employment tax, if you were self-employed, then you've got self-employment tax. And then Schedule 5 is like your estimated tax payments and some other certain credits. So again, if you think of the 17 return and the 18 return, the core of it is relatively simple. That's the postcard type piece. But then there's like 5 different schedules that you can attach to the extent that you have something outside of kind of the very, very mainstream. And as we see tax returns, most people have at least 1 or 2 items that fall outside that mainstream. So you'll be adding a schedule to your return. Overall, to Frank's question, what's the pattern? Seeing these news reports that say, more people are paying more. That's a misconception in my opinion, Frank, because when we're looking at these returns, certainly there was some adjustment on the tax withholding, so people wound up getting more of that sort of along the way. But at the end of the day, there was a pretty significant drop in tax rates across the board. One of the returns that we saw this week, which is actually one that was something that was triggering child tax credits, things like that. We do mostly retiree returns, so we don't see those as much with the young kids on them. But that one in particular, or 2 of them actually this past week that we saw, the child tax credit really did more. The increased child tax credit from $1,000 up to $2,000 really did more than compensate for the loss of the personal exemption. So one of the comments that we had made in the past was that when you go to this higher standard deduction, you're going to eliminate your personal exemptions. What impact is that going to have on that family of 4, that family of 5 with young kids at the house? Interestingly, it more than made up for it. They wound up getting, the number off the top of my head was they wound up getting $800 more than they did last year based upon the nearly identical return. The one caveat that we are seeing is for folks that have a lot of capital gains, that their taxes went up simply because the capital gain distributions went up. Odd situation last year, we had a lot of capital gain distributions, even though the year itself was not particularly a great year performance-wise. So those are the trends that we're seeing so far. I've probably reviewed less than 10. So, but some interesting trends so far. Great question, Frank. We will talk about the trends as we go forward through tax season. So maybe in another 3 or 4 weeks, we'll be able to kind of talk a little bit have a little bit broader cross-section on that, and we'll circle back to that topic. We're going to take a break. When we come back from the break, we'll get to our last topic du jour, which is some of the conversation that happened at our first client meeting of the year this past week. We want to share with you that conversation. And I want to get to one of the questions that was asked in the Q&A, which I thought was a pretty interesting question. So we'll do that when we get back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, Dollars and Cents, here on News Radio 93.1 WFLA. So we'll hit the Q&A from our client meeting this past week. And one of the most interesting questions, and kind of touched a little bit on it in my tangent on required minimum distributions and raising the age, and they really need to focus more on raising the age for Social Security and Medicare, because the question dealt with debt. Okay, the question dealt with the debt load of this country. And to put it in perspective, it's not just this country that's going down this primrose path of borrowing money. It's pretty much every country, and China in particular has a much greater debt level by some estimates, because you can't ever really get accurate data out of the Chinese government. But by some estimates, that their debt level is significantly greater than even ours. So you hear this conversation, so certainly the question was, what's the long-term impact of that? And at some point, you're going to have to pay the price on that, right? I mean, think of it financially, in your personal situation, right? You keep borrowing money, and, eventually something happens or that really puts the strain on your ability to cover those debt payments. And the bigger the debt is, if something happens that puts a strain on those debt payments, well, then you're in trouble. And so it's an important conversation to have, and I don't think the folks in Washington really are interested in having it. Their tax proposals are aimed really more at redistribution, not ultimately solving the problem of the underlying debt. And so we made 2 comments in the Q&A, so I'll share with you those comments. Number one, I do think that we are at historically low tax rates, and I think they're probably unsustainable. I mean, these tax rates that we have right now have sunset provisions that occur typically in the year 2025. So all of these tax changes that we've been talking about in programs so far this year, remember, they all have sort of sunset provisions in 2025 where the old rates go back. I think they will sunset in 2025, if not before that. You've still got another election cycle to go through, particularly 2020. So you could see things change. So the bottom line is enjoy these low tax rates, because I don't believe that they will be here long term, and certainly they're not intended to be. That's number one. Number two really does deal with Social Security and Medicare. I asked the audience, those that were under 40, you're probably going to see your Medicare age, your Social Security age, all of that go up well into the late 60s, maybe into 70. Certainly if they're kicking around 72 and 75 as the ages to delay required minimum distributions too, that's, those are later ages, and increasing the age would certainly do a lot to help solve the overall finances that face the government. That is for sure. Other things that we talked about, obviously, one of the big questions that comes up in terms of the economic cycle is sort of, here we are, and you hear it all the time in the media. By timeline, it is one of the longest recoveries post a recession, and so the suggestion is, because it is a long time, then it must mean that it's going to die of old age, and the reality is that that's not really how economic cycles go. Economic cycles eventually shift from expansion to contraction when something happens, something gets overblown, something gets ahead of itself. Those types of factors typically come into play. What's interesting about this current expansion is that the recovery has been relatively slow. I mean, typically your recoveries would be at around 3%. This one has been pretty much at 2%. Maybe last year you'll get to 3. I think probably you did get to 3 last year. In terms of but if you go, stop and think about this. If you go 6 or 7 years at 3%, right? How many years do you have to go at 2% to get to the same level? Well, you got to go 10 years. So it's a much longer runway, because you are seeing a much lower level of economic productivity. I was also reading an article this past week that was interesting in that it also suggested that technology, automation, and the productivity gains have also perhaps contributed to this over the course of the past 10 years. It's funny, you look back 10 years ago, we were not all walking around with smartphones. I mean, it's kind of fascinating. I mean, we might have had phones, we might have had the flip phones, you might have had maybe a BlackBerry, something like that, but not anything like the technology that we possess in our pockets today. So I think that really, excuse me, that really does make a significant difference in productivity and what you're able to do. That I think might not get fully reflected in the economic numbers, but in terms of things to kind of worry about. I mean, obviously, and we've been talking about this on the program. It's the Federal Reserve and it's China. What's fascinating about this market rally here in 2019 is that the Federal Reserve really has sort of taken very much a very different tack all of a sudden than what it has been doing towards the end of last year. And that's pretty significant and in fact quite necessary, because when you look at sort of what's going on around the rest of the world, clearly interest rates are not trending up. And in fact, interest rates of late have been trending down. If you look at the 10-year German bond, it went down. It's right now at about 0.4% per year. The Japanese government 10-year bond is basically even like less than zero. So if you have two of those major economies at zero or at 0.4, equivalent to zero, and then when you look over to the U.S. Treasury and you're looking at 2.6, 2.7, gives you some idea, wait a minute, maybe we are okay on the interest rate side. So that helped to resolve a lot of the issues. The big issue, of course, still remains China and how that plays out. The Chinese economic situation is much more tenuous than ours. There is a real pressure on them to come to some sort of an agreement, particularly on this trade. So I think ultimately you'll see that sort of get resolved as well in the weeks and months ahead. But those are some of the highlights of the conversation this past week in terms of our first client meeting of the year 2019. So we covered a lot. Hopefully you followed us through and I didn't get off on too many tangents along the way. If you missed it or didn't seem to make any sense, you can listen to it again and make sure that I didn't make sense on our various podcast channels available through our website, NelsonFinancialPlanning.com. Have a great day. It's a little gloomy out there, so maybe grab a raincoat on your way to church this morning. This has been Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hettinger, and you've been listening to Dollars and Cents with Joel Garris of Nelson Financial Planning. If you missed any part of today's show or want to listen to it again, check out the radio show at www.nelsonfinancialplanning.com or connect with them on Facebook or Twitter. Be sure to call Joel this week at 407-629-6477 to schedule your free consultation to discuss your retirement plan.
Fees, commissions, expenses, investment costs come in all shapes and sizes. Do you know how much your investments are really costing you? At Nelson Financial Planning, we believe that costs should be a major consideration in your financial plan. After all, the lower your costs are, the more you get to keep for yourself. This is Joel Garris, and I invite you to get educated about your investment costs. Visit NelsonFinancialPlanning.com or call us today at 407-629-6477 to set up a personal conversation to review your investment costs. That's NelsonFinancialPlanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC and FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 93.1 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.